Hi, this is Aaron Engelman with Two Teachers Tax Service in Lyman, South Carolina. Today, I want to talk about the changes for 2026 for the Child Independent Care Credit. The Child Independent Care Credit is a federal tax credit that helps working people cover the cost of care for children or dependents. It applies when the care lets you work or look for work. It is not a deduction. It reduces your tax bill dollar for dollar. This credit is unrelated to the child tax credit. You may claim the credit if you paid someone to care for a child under 13 years old, or you paid someone to care for a disabled spouse or other dependent. The child lived with you for more than half the year. The caregiver is not you, your spouse, your dependent, or parent of the child. And you and your spouse must have earned income from a job or be looking for work. How much is the credit we're talking about now for the 2025 tax year? Well, the credit is non-refundable, meaning it can reduce your tax bill to zero, but cannot generate a refund. If you have one qualifying person, the maximum expenses allowed are $3,000, and the maximum possible credit, remember this is for 2025, is $1,050. If you have two or more qualifying persons, the maximum expenses allowed is $6,000, and so the maximum possible credit is $2,100. What are the changes for 2026? First of all, there is an increased credit rate, meaning the maximum credit increases from 35% to 50% of eligible expenses for lowest income filers. The higher maximum benefit example. For one child, the maximum credit may reach $1,500. That's 50% of $3,000, or for two children or more, the max becomes $3,000. The credit percentage phases down more gradually as income increases for 2026 instead of a steep reduction. And the expense limits remain unchanged. The eligible expense limits remain $3,000 for one child or $6,000 for two or more children or dependents. Lower and middle income families who pay for childcare may get larger tax savings in 2026. Because the credit is non-refundable, if your tax bill is too small, you might not get the full benefit. You should plan childcare expenses during the year to maximize your credits. This time of year, January, you may want to consider lower and middle income families who pay for childcare may get larger tax savings in 2026. Because the credit is non-refundable, if your tax bill is too small, you might not get the full benefit. Plan childcare expenses during the year to maximize your credits. Employer-dependent FSA accounts may offer additional tax savings. Two Teachers Tax Service can help you maximize your credits and deductions. Please contact us at 269-449-8277 or by email at twoteacherstax@gmail.com. Thank you.